My goal was financial independence, right? That's the buzzword that we're all chasing. And even though I matched my income with what I was doing with pacemakers through that, it gave me a level of financial independence, but what it did not give me was time or location independence. What we all really want is financial time and location independence, because those three things together create an independence of purpose. And that's kind of what led me to my aggressive pursuit towards investment strategies that were more passive, which eventually led me to storage, which eventually led me to syndication.
Hello, this is Gary Wilson. Welcome back to the Massive Passive Cash Flow Podcast. I'm so glad to have you back listening or watching, if that's the case. We got a great guest today, Clint Harris from Nomad Capital, and he's got a great, interesting background, and he's involved in investing himself, and he does capital raises too. So this is definitely one you want to pay attention to. If you're driving, just please keep driving. You can get the show notes later on. You can log in and get the show notes. And we appreciate you doing that. So in any case, if you're not driving, this is definitely one you want to take notes on. So first off, Clint, man, thanks for joining us. I appreciate you taking your time to do this. I know what it's like when you're in business. You hit the ground running when you wake up, and you're usually when you go to bed, it's you're asleep in 5 minutes. So I appreciate you taking your time to share with our audience.
Yeah, I'm happy to be here. And you know how it is. I've got full speed, and then I got a 4-year-old and a 1-year-old at the house. So yeah, I hit the pillow pretty hard at the end of the day. That's for sure.
Oh yeah, they're runners. We call them runners.
Man.
The little ones.
I'm playing zone coverage. I got two. Yeah.
Oh yeah, that's amazing. So in any case, if you could fill people in a little bit about how you actually got started in this, because most of us weren't born doing this. We in other words, when we were younger, like your 4-year-old, he's probably saying, "Hey, Daddy, I want to be a policeman or a fireman or an astronaut or something." But what was it that brought you into this? If you can take us back to a pivotal moment.
Sure. So the backstory is, first of all, my name's Clint Harris, married, 2 little boys. We live in Carolina Beach, North Carolina. I had a 16-year career in medical sales. I was implanting pacemakers and defibrillators. In college, I was pre-med, ended up switching and getting a business degree, but I still wanted to stay in the medical field. So I spent 16 years in the cath lab and the EP lab and the OR, implanting pacemakers and defibrillators as a representative for a company. And they kind of worked my way up through the chain. And eventually, that's how I ended up. I took a promotion and moved to Wilmington, North Carolina to take over the territory here. But that lifestyle is a little bit of a young man's game. As you can imagine, heart problems are not 9 to 5, Monday through Friday. It's all the time. A lot of being on call, getting called at 2 or 3 in the morning, up to 2 to 3 hours away. People getting shocked by their defibrillators or whatever it may be, going to the emergency room all hours of the day and night, and in a fairly large territory. So I kind of knew, even though I loved it and I was blessed to be pretty decent at it, that eventually there was going to come a day when I probably didn't want to do that anymore. I also believe that in my generation, the ability for us to save our way to retirement has likely been taken away from us through bad fiscal policy. Our parents and our grandparents could save their way to retirement through pensions and 401ks and everything else. I really believe most of that option has been taken away from my generation. And so I knew that I needed to create an off-ramp from that lifestyle, and I had to find a way to replace that income. And so I looked around, and real estate for me was the easiest way to do that. And fast forwarding a little bit, my first house that I bought was a duplex. I think I was 24, lived in one half, rented out the other half, lived there for free. I thought I was a genius. I thought I'd invented some new concept, but it's been going on for thousands of years. And that kind of sparked things in me that real estate was really going to be the direction I wanted to go in. So built out a small portfolio of 9 single-family homes before I figured out that's a very slow way to get ahead and not scalable in the long run. In 2017, my wife and I took a promotion. We moved to Wilmington, North Carolina. It's a beach town. That opened up the opportunity of short-term rentals and doing Airbnb. So I remembered that lesson from the first house that I bought that was a duplex, and we bought a duplex at the beach, 2 blocks off the water. We renovated. We moved into one half that was a 3-bedroom, 2-bath. We started running Airbnb out of the other half, and we did 60 grand our first summer. And I was like, oh, this is real money. It's paying for the house, the mortgage, the taxes, and a little bit on top. And all of a sudden, we're back to getting paid to live at the beach. So from there, I was still selling pacemakers on the side. We bought a quadplex, and then another quadplex, and then another quadplex, and then converted all those into, got out the long-term tenants that were kind of beating the property up, renovated, turned all of those units into short-term rentals, built a house for ourselves, moved out of that other side of the duplex and rented that out. So we still have those 14 Airbnb units. That turned into a property management company with some partners that manages our properties and another 80. And that was great. But I'll be honest with you, Gary, I did something really wrong there.
Okay.
My goal was financial independence, right? That's the buzzword that we're all chasing. And even though I matched my income with what I was doing with pacemakers through that, it gave me a level of financial independence, but what it did not give me was time or location independence. Because even when I wasn't working, I was basically on call. I had my phone on me, messaging these different properties or dealing with the property management company that we had built. And I realized that I had financial independence at the cost of time and location independence, which is the opposite of what I wanted. And it was that point in time, I kind of realized what we all really want is financial time and location independence, because those three things together create an independence of purpose. And that's kind of what led me to my aggressive pursuit towards investment strategies that were more passive, which eventually led me to storage, which eventually led me to syndication.
Okay, awesome. Right. Good, great story. And I mean, I appreciate you sharing on that, because now that puts us to where we are now. So, and by the way, my memory's kicking in. So I remember one part of the conversation we had about your boys and maybe doing some what I used to do, speaking and all that. And it's a lot of fun, but really, for me, honestly, I just always like the thrill of the hunt. I like being in the game. I'm happy to teach it. I run a big team, a national team of agents that we call them investor agents. They're trained to work with investors, and it allows me to stay close to the transaction, but yet I don't have to travel all over the place. It's just a much, much nicer scenario. And what you're doing, you can do the same thing. I mean, you guys could travel and do this from anywhere. I mean, you're in an awesome place, by the way. I think I told you before, that's where I actually learned how to surf.
Yeah, that's right. I remember that.
Yeah, very, very poorly. but my nickname's Entertainment. Let's watch this guy. It'll be a lot of fun. So in any case, so what you're doing now, let's kind of unwrap this a little bit. So it allows you to stay involved with the game of investing, and yet you have the ability to do capital raises, so you can take on a lot more projects, or you can take on bigger projects. I mean, what would you say is your ideal, your avatar project, and the people you like to attract to participate if it's something you want to do, like in a syndication? Because there's a lot of people listening, I'm sure, would love to participate. They just don't really have the time. They're busy.
Right.
So
yeah, with successful people, to have success in any type of real estate investing, you have to have three things. It's time, it's experience, and it's money. For most busy professionals, what they don't have is the time, right? Without time, you can't get the experience. So if you're a high earning income individual and you're making good money, the reality is, instead of you taking, your time is worth a lot. You're making a good income. Instead of you taking your time to get experience, a lot of times it's better to just take your capital and partner with someone that does have the time and experience. And that's what syndication is. It's where you pool money together from a group of people to take projects on larger than what any one individual could do on their own. The syndication projects that we focus on it's the most passive strategy that I could find. And my partners had started doing it years before me. They're a father and son team of Eric and Levi Hemingway. And I partnered with them. And our strategy it's self-storage. You're renting someone a box of air. It doesn't get much easier. There's no kitchens. There's no bathrooms. It's very good for a long-term hold. I'm 41 years old. So my plan is we're building a portfolio that we can hold for a very long time to generate that cash flow that everybody's looking for, right? The name of our group is Nomad Capital, because a nomad is somebody that goes where they want, when they want, and does what they want, because they have a portfolio of commercial real estate. So we've done everything in the past, from ground up development and expansion projects where you buy an existing facility and add on. But our bread and butter, the last 4 years, all we have focused on is conversion projects. And our specific focus is we buy old, vacant, big box retail buildings like Kmart's, grocery stores, and warehouses. We convert those into climate controlled self-storage. We can do that for about half the cost of ground up development. And then we can do it in about a third of the time. So it will go buy an old Kmart building that's been sitting empty for a dozen years. We'll buy the building for a fraction of the replacement cost, $20 to $25 a square foot. we'll put $40 to $45 a square foot into it. If you and I built a self-storage from the ground up right now, it's going to cost us around $120 a square foot plus the cost of the land. In the last 4 years, we've done 2 Kmarts, 3 warehouses, 2 textile mills, a grocery store, and a soda bottling facility. And across that portfolio, when they're converted to climate controlled storage, our average is just under $65 a square foot. That's the building, the land, the parking lot, the construction, all of it. And on average, from the time we close on a property, we're open 12 to 15 months later. So we love the conversion strategy. We have in-house construction and in-house property management. And our model is across the Southeast, we move into these secondary and tertiary markets that are having big population growth. People are pushed out of these primary urban areas like a Charlotte. They're being pushed out of there, but the small town of Gastonia, right outside of Charlotte, 15 miles away, is having tremendous growth. It's underserved for storage. There's tons of multifamily properties coming in and building there. And our model is we'll move into that town. We'll buy the old soda bottling plant or the old Kmart right in the middle of downtown. We'll have it converted in 12 months and we'll have it cash flow positive 18 to 24 months after that and cash flowing. And it's a lot faster than the 3 to 4 years it might take to do permitting and break ground on land and engineering and entitlement and everything else. So for us, it's about that velocity. And we're currently sitting at 150 million in assets under management that we've done since starting syndication in 2021. That was really the moment that the first Kmart that we bought for 1.5 million and we put 2.5 into it. We're into it for 4 and it's appraising for 9. I'm like, okay, we're on to something here. That gives us the opportunity to do cash out refinances and pay our investors out by way of refinance, which by the way makes it non-taxable. But that was the moment for me that I was like, okay, I just sped up my timeline a lot. And we did another deal, another deal, another deal. And then in November of 2022, I took off my scrubs for the last time and have been a full-time real estate investor ever since.
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live, be ready to take notes and ask questions because it's live and engaging and you get to participate by asking questions and meeting others. So we'll see you there. Go to realestatewithgarywilson.com, click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. That is awesome. I love hearing that. That's the point when you actually bought your free, when you actually realized you bought your freedom. And I remember for me what that was like. It was in fact, the anniversary is coming up. It was August 13th, 2003. And I'll just tell this briefly because it's so funny. The prior Christmas, there was a major layoff, and I was one of the guys having to lay people off. And I was right up underneath the C-level guys, and they told us the night before. They called us in on a meeting like 5 p.m. and said, "Hey, we got to have this emergency meeting." I thought, and I was in IT, so I knew the numbers. We had a great quarter. I was like, "We're going to give everybody a nice Christmas bonus. This is going to be awesome." No, it was the announcement of a major layoff the next morning, and they didn't even include us. They just decided themselves and picked everybody based on reviews, made some major mistakes. But anyways, the next morning changed a lot of people's lives. It was a Tuesday, and that Friday was Christmas Day. And I thought, I can't do this. So I told my boss the next morning, I said, "Look, I'm going to do my job. I'm going to toe the company line, but I'm going to be leaving here eventually. I just want you to know it. And it's not really because of this. It's just because I'm financially free. But what you did was wrong. There was 2 people you chose that you should have chosen because they were new. They're both MBAs. They're excellent learners, and they're just starting to find their own. In any case, so long story short, in August that year, I had I'm sweating because I had all my stuff in boxes. I'm walking out with my dolly with all my boxes, My tie is kind of hanging in my pocket. My sleeves are rolled up. I'm sweating. And I'm at the street corner. These guys, kind of walked up next to me. They were going to cross too. They looked at me and said, "Oh man, we are so sorry. Can we help you?" And I said, "What do you mean?" And they said, "You must have got caught up in some of those lefts." I said, "No, I just retired." And they looked at me. I the look on their face. I just started laughing. I thought I've actually realized the American dream. So I'm like walking, cloud nine out to my car, and the rest they say is history. But everybody listening, I'm telling you this, and I want you to listen to Clint's story too, because both of us came from different backgrounds. You know, I'm not a superhuman person, just a regular person. But I was lucky because I had a very, very awesome, excellent opportunity, and I did not want to let that pass. So I took full advantage of it. In any case, let's get back to you and your story. If Take us forward. So you did the project. Was that first one? Was that a capital raise, or was that one you did on your own?
No, it was a joint venture. So it was actually my
Okay.
partners and I, we put money in, and then I grabbed a handful of the doctors that I worked with and told them
Yep.
about it. And we did it together as a joint venture. So that was proof of concept leading to syndication. Even though my partners had done conversions in the past, they were smaller projects. And this was, it was a
Right.
90,000 square foot Kmart. It was a big boy project. So we did that one as a joint venture, and then that led into syndication and doing all the
Hmm.
legal work and the SEC filings, and then off to the races. And now I'm one of the 4 general partners with Nomad Capital. We've got 16 employees. We've got about a dozen facilities. We got a fund that we've opened up. So I'm about 6.5 million in on a $10 million fund that I'm raising right now. We've got the first 2 projects closed in the fund. We just went under contract with 2 more. Yesterday, I found out we have a letter of intent accepted on another property after that. So we're
Nice.
full speed ahead, and our plan is 500 million in 5 years and a billion in 10.
There you go. Now, uh, is the model strictly based on purchase and having, gaining control of the property, ownership of the property? Have you ever looked at a potential like a long-term 99-year lease, anything like that, or is it either way is okay? I'm just curious because I've seen that. In fact, it was Beaver Valley Mall in Beaver County, Pennsylvania. In the pandemic years, the malls were empty.
Right.
But
Yep.
there was an old, I don't know what it was, a Sears or something, who knows. Well, U-Haul took it over because they offered storage, and of course they had all of the vehicles and everything. And I thought, what an ingenious idea. But I talked to the owner, and they were leasing because, of course, the mall is giant, and
Right.
you can't just buy a part of the mall, but or maybe you can. Um, but any thoughts on that? I'll give you my feeling is I prefer ownership. I
Sure.
would, if I can own it, I'm going to figure out a way to own it.
Well, let me unpack that a little bit. So you got to
Okay.
keep in mind where we are in the country. The key for us is
Yeah.
the feasibility study, looking at the demand in the market, right? And then the
Hmm.
residential density in a 1, 3, 5, 7 mile radius, the amount of storage, price per square foot, median age, median income, number of people per household, percentage of renters versus owners, all these different things. And then we're kind of looking at the building itself. We have
Yeah.
looked at a long-term lease situation on a Kmart building that was in South Carolina. And the reality is it's not for us because deal flow is not a problem. At one point in time, there was
Yeah.
2,000 Kmarts in the country. They are all closed.
Yeah.
Textile
Yeah.
mills, warehouses, Bed Bath and Beyond is just announced that they're going under. I can't remember. There's another big box store this past week that
Yeah.
mentioned they're closing 50 locations. The reality is deal flow is not a problem, right? It's
Right.
just about the location. We're looking at 50 to 70 deals a week with our acquisition team to get
Okay.
down to 2 to 5 probably that we're going to do underwriting on, to get down to
Okay.
1 or 2 a month that we might send a letter of intent on. So we've never found a deal that was so good that we're willing to compromise on our core values. And our core values
Yeah.
are we want to come in and we want to live in our footprint, which is North and South Carolina, Tennessee, Virginia, and Georgia. We're going to buy these
Okay.
old vacant big box retail buildings for less than $25 a square. We're going to do the construction in-house, convert it to climate controlled storage. We're going to lease it up with our own management. At stabilization, we have such a low initial purchase price that we are landing between 35 and 38% loan to value, which means
Nice.
we can do a cash out refinance to 55 or maybe 60% loan to value. We have never used variable rate debt, by the way, and we never will. Always fixed
Yeah.
rate debt. That allows us to pay out our investors by way of a refinance when you pay the investors out by way of refinance, it's not a sale, which means it's not a capital gain, which means it's non-taxable. Our
Right.
goal is to try to double everybody's money tax-free, but after that, everybody stays in. We keep the properties. Everybody keeps their same percentage of ownership. You hold it
Yep.
long-term. That breaks the bond of trading time for money. If we're just building up assets and making them nice, and then we have to liquidate and sell that to get a payday, that's great. And I'm not knocking anybody's strategy, but you're back to
Right.
trading time for money and you're a glorified house flipper. What we specifically are after is those three things we talked about. It's time, location, and financial independence. Those things
Right.
together create an independence of purpose. For us, that means owning instead of leasing. It means full vertical integration. We have an acquisition team looking for the deals. We're building them out and we're managing them. We don't pay retail costs for the building. We don't pay retail costs for the construction. We don't pay retail costs for the management. It's all
Yeah.
about landing at a low enough loan to value that we can refinance the property, pay everybody out,
Right.
including ourselves, and keep it. That's the key, is
Yeah.
hold on to the properties. That's what creates what we like to call real estate nomads. So that's kind of
Yeah.
our core values. When you are the builders, there's a lot of shiny object syndrome. And we look, oh, we could do build to rent communities. We can do this, we could do that. Look at this deal over here. We have our investors, we have about 150 investors in our investor pool, are throwing deals at us all the time. 30 minutes ago, I had somebody email me, hey, I've got this building over here. He was in California. Yesterday, it was somebody in Texas. I've got this building. Will you guys partner with me and come convert it? We're not doing that because our responsibility is to take care of our investors first, and our footprint is where we are. And our job is to get really, really good at what we're doing. And we want to do one thing and do it really well. So we kind of have carved out exactly what our model is. That's what we're sticking to. We have the deal flow to get to our goal, which is $1 billion in assets under management. We're sitting at 150 right now, and we've never sold anything. That doesn't mean we won't. We will trim the portfolio, and we'll kind of prune things as we go along to make sure we end up with the assets that we want. But that's really hard to build a $100 million, in this case, $150 million portfolio without selling anything. The only way you get there is massive value add. And the only way that I've seen massive value add is an asset class conversion, or we call it adaptive reuse. You take an old vacant big box retail building that not only does nobody want 100,000 square feet of retail right now, the town is just ready for someone to do something with the old building, right? So we take that, we convert it to a new asset. When you change the asset class, it changes the formula by which the asset is valued. Massive appreciation. Everybody can benefit from that together. We could have decided that we're going to refinance and push the investors out of our deals. Our strategy is we are trying to build a tribe of real estate nomads, and everybody stays in the deal, keeps their equity, and hopefully create real estate nomads.
Yeah. I'll tell you what, I love the fact that you're disciplined to stick with your model. And I've been around long enough to see a lot of other successful people too. And that's one of the key character traits is they generally they develop something that works, they like it, and they just keep doing it because it's easy. I tell you, I mean, people come at you. I'm sure you've had it happen to you too, left and right, pitching you this and that and the other thing, and it all. I'm sure it's all great and it all works for them, and it may even work for me. But the thing is, when you're starting up, that's when you spend the most time, energy, and money. The three things, right? And if you already have something that works, and your ultimate aim is, to be with your sons, to be with your wife, and travel and enjoy the fruits of your labor, why take on more work? And I know I just ruffled a lot of feathers there because a lot of us entrepreneurs, we're natural born work dogs. We have to keep busy, but it doesn't mean you have to, try all these other things. Just maybe expand what you're doing. So by the way, a couple of areas that I've noticed in kind of northeast of Charlotte is Kannapolis and Concord. I don't know if you've looked up there, but I taught there before. I went back this last year. I'm like, holy cow, they're really growing,
Yeah. Concord's great. Yeah, we're underwriting in that area pretty heavily. We're based in North Carolina, so we have a lot of properties in that kind of area. Like we're in Burlington, Kernersville, Gastonia, Lexington, North Carolina, Danville, Virginia, kind of right in
Yeah.
that area. Reedsville, North Carolina. There's a lot of really good spots in there. The population growth, especially in eastern North Carolina, is
Oh
amazing.
yeah.
Yeah.
Yeah. North Carolina, it goes back a generation. The I-85 corridor. I mean, when I was a kid, Charlotte was a decent sized town, but I don't think they didn't have a major sports team. They didn't have, we call it the Taj Mahal, the big building that Hugh McCall
Yeah.
built, had the gold top, and, sports teams, major airports, all that stuff. And as a kid, that highway has been being worked on for the last 50 years,
Yeah.
all the way down to
And the next
upstate.
50. Yeah, that's
Oh my
right.
gosh, yeah. But Greenville, Spartanburg, I mean, just an amazing corridor there, all the way down to Atlanta. So up in Virginia, I have to ask this because I'm actually in Virginia now. I'm, technically from Virginia. I don't really live here. It's just I'm here temporarily. But, um, you've got the Tidewater area that we call the Seven Cities. Norfolk, Virginia Beach. Hampton. It's all Hampton Roads area. And the Northern Virginia, of course, is always growing because government is always growing. And people will say, well, no, the Republicans don't like the government. Like, yeah, really? Well, they both have expanded the government. And it's
Right.
expanding out further and further down to Fredericksburg. Manassas is now a bedroom community for DC. But then you've got Richmond, Charlottesville, Roanoke, Lynchburg. I like Lynchburg myself. It's just north of Danville. Another, I don't know, maybe 45 minutes or something. But where in Virginia, is there a particular area in Virginia, if you don't mind sharing, that you're really keen on, or is it just really the up in the Danville area?
Well, if you think about what matters with storage, it's about a 7 mile radius. Like that's about as far as people want to drive. You're going to your closest storage. So even within a city, there might be different pockets and areas that are better than others. And it has to do with how much storage is there, what's the average price per square foot. And so there's a micro economy that you have to dig into. That having been said, yeah, we have a LOI out right now on a property in Richmond. And it's really kind of the way we look at it. Our properties are basically competing with each other to which ones are going to make it to the top of the list to get an LOI. And a lot of it has to do with the vehicle count, the visibility, the residential density, and the feasibility study. But also the biggest thing is obviously the price per square foot of self-storage in that area and how much existing storage is there. And then you're going to get on down to how bad's the building, what's the cost of the building, what's the construction, blah, blah, blah. And, a 60-page feasibility report doing a deep dive on the area. So we're competing against those, and we try to put ourselves in a situation where we're not necessarily making the decisions. The numbers and the acquisition team is making the decision for us. And then those properties are basically in competition with each other. And then you're looking at things like the project has to stand alone as it is. But then there are things you look at like, okay, this one has 22-foot ceilings. We could add a mezzanine and add an elevator and create double the footprint. Can the market sustain that? What does the engineering and the construction costs look like? We're doing that right now on a property that we have under contract in Florence, South Carolina. And then we're looking at things like, okay, we don't need a giant parking lot with this Kmart. Can we fence it in and do boat and RV parking? Can we do semi-tractor trailer parking? We're keeping an eye on things like in the future, what do the federal dollars look like to put solar on the roof? There's all these little spin-off things that are there.
Yeah.
But the reality is the project by itself has to stand alone. And again, deal flow is not the issue, right? It's been tougher raising capital this year than it has the last few years. Whether anyone wants to admit it or not, I think we're in a recession. It's an election year. There's a lot of uncertainty. So because of that, we have a $10 million fund going on right now, and it's been slower to fill that than it has in years past. And so that's part of it. We're still finding great deals. Obviously, the interest rates changed. We were putting deals under contract at 3.75% a few years ago, and now it's 7.75 to 8.5. I always fixed rate debt. The deals are there. The structure is just a little bit different, but the deal flow is not a problem. The construction was honestly a bottleneck last year. We spent all of last year tripling the size of our construction department. So now we are poised and ready. We feel like we're getting pretty good at this. We're going to keep going until we're great at it, and just keep on rolling.
Yeah, I love it. By the way, Richmond, it's one of my favorite areas right now because probably a decade ago, it was kind of taking a beating. I mean, they had lost four of their major Fortune 500 companies, but it really bounced back in a big way. And there's so many nice bedroom communities around their beltway. And you've got 95 coming north and south. You got 64 going east and west. You're an hour and a half from the beach, an hour and a half from the mountains, 2 hours from DC. It's just geographically an excellent area. There's rivers close by.
Yep.
But for a while there was taking a beating and they got their nose bloody because of bad crime reports and industries leaving. But it's not that it's growing now, and it's still a very affordable place.
Yep.
So any case, hey, now what about timing? And timing's to me, it's like a two-part question. Timing as far as where we are in the economy, and like you said, we're in an election year. There's always uncertainty there, but also timing in someone's life. So we have listeners now that are running the gamut. They're dentists that are just starting out right out of college, and they're looking to buy their own practice or build their own practice. We got people like my age that are, I'm not looking at, I've already retired, but they're looking at retirement. And to me, man, Clint, this is like an ideal vehicle for someone who doesn't want to rely just on annuities and things that like the stock market and mutual funds. I'm not knocking them. I have those things too. But something like this for a portion of a portfolio to me is an excellent vehicle because while everything has risk, if you look at what the model is, and it's fundamentally self-storage, that industry is showing no signs of slowing down. There's always room for more because the population keeps growing and you're going to the right areas. In any case, sorry to ramble on there, but where we are macro time-wise and economically, politically, I would just want your thoughts on that. And then for individuals, what is there a good time for them to be getting into this? I
Sure.
mean, probably a good time for everybody, but if you don't mind addressing that a little bit, everybody always asks you those questions, and I'm like, I don't have a crystal ball, but let's ask them anyways,
Yeah. So it's a great question. Let's unpack storage a little bit, and then I'll talk about timeline in terms of from the investor perspective. First of all,
Okay.
self-storage has been the top performing commercial asset for the last 30 years. It's had 18.8% annualized average growth since 1994. If you put a $50,000 investment in back then, it would be worth over $5 million now. That's obviously a little bit anecdotal, but it's not going anywhere. We've had massive growth in this industry. It's also very inflation resistant. It's on a month-to-month lease. The only thing more inflation resistant as a commercial real estate asset is a hotel, because a hotel can change the rate on a night-to-night basis. That having been said, in a recession, typically people use less hotels. Storage is basically recession resistant, inflation resistant, and we now know pandemic resistant as well.
Yeah.
So from a long-term hold standpoint, it's very good. Also, when you open up a new facility, the expense ratio is about 30%. That's the lights, the AC, the staff, the landscaping, somebody sweeping the floors, and doing promotions, 1 month free, half off here. As you own it longer and longer, that storage expense ratio drops around 21 to 24%. Very good asset for the long hold, especially because the inflation resistant part and the ability to change the prices rapidly. So as an asset class, doing very well. What is one of the trends that we're seeing? The biggest change we're seeing is in the younger generational use of the project. Millennials are now 34% of the population. That is the largest population segment in the country. They now are larger than the baby boomers. They're using 38% of storage, but the way they're using it is very different. The average consumer previously would have non-climate controlled storage, and they'd be in there once or twice a year with Christmas decorations or bulky furniture. The millennial population is in the property once or twice a month, if not once or twice a week, because they're using it differently. Wow. Millennials are not able to buy houses the way that the previous generation did. They're renting. And when you rent, you're typically renting based upon the amount of square footage that you get. So instead of paying $1,800 for a 2-bedroom condo, they're renting a 1-bedroom condo for $1,300 a month. And then they're getting a storage unit for $150 a month. And they still have stuff, but it's not the same stuff that the baby boomers had. Theirs is more lifestyle items. It's mountain bikes, kayaks, snowboards, wakeboards, this kind of stuff. So they need to be able to get in their unit at 6:30 on a Saturday morning and get their snowboard and their bibs and get out of town, right? So if you're going to invest in self-storage with us or with anybody or do it on your own, it needs to be several things. It needs to be safe, secure, well lit, easy access, centrally located, and it has to be climate controlled because people are using it as an extension of the closet or the garage. These are lifestyle items. Besides that, obviously you have businesses that are closing down and storing things. You have businesses that are getting rid of warehouse space and using storage as a micro distribution center. So all those are different components that we have. So that's kind of storage as a whole, why we love it as an asset class, especially for holding it long term. And that's why we love the conversions, because we can get into it for half the cost of new development and in about a third of the time. I think most people would agree most deals out there are probably a good real estate deal if you can get it for half price. So that's kind of our model. Now, beyond that, from the perspective of the investor, I think this is a very strong vehicle for people to create wealth outside of that. And I'll unpack that a little bit more. But the first thing I want to say is, if you are an active investor and you're out there and you're flipping houses and you're wholesaling or you're doing all the things, you're a real estate agent, you are probably going to make better returns than you will in syndication. We're going to pay you like 21 to 24% annualized rate of return. You can probably go make 30, 35, 40% flipping houses, doing all the things. But you're going to be trading time for money to do that. You're going to be hustling. You're going to be doing it. And if you're flipping houses, you're wholesaling, or you're a real estate agent, or you're doing one project after the other, if you zoom out and you look at your life 20, 30 years from now, I think you'll recognize that you're trading time for money. And the day that you stop working is the day that you stop getting paid. The key is to make the jump to where you're no longer trading time for money. So I think a syndication is a really good way to do that. You can partner your capital with someone else's time and experience. And those three things together are what you need to have success with real estate. Now, there's all kind of different syndication offerings. You can do a vineyard or ATMs or multifamily apartment complexes or RV parks or whatever it may be. For us, the key is not buying assets, fixing them up, making them nice and selling them. The key is assets that we want to hold long term. That's why we like storage, because it's a great asset for that. The one thing I would say is everybody needs to have a goal of what they want for their life. And in terms of taking action or not taking action, I think everybody has to look at their ceiling. Like I had a ceiling selling pacemakers and defibrillators. Now it was a pretty high ceiling, but it still has a ceiling. You should be able to calculate what your ceiling is if you're trading time for money. If you look at that ceiling, whatever it is, higher or lower, if you look at that ceiling and you have a discussion with yourself about your life with your spouse and your kids, if that ceiling is not high enough for what you want for your life, the only real risk you have is not doing something differently, right? So I'll just put that out there, that I think it's an easy way to take action when you realize that the current ceiling you have is not enough. You better either get content with that, or the only real risk is not doing something differently. I will also say, if you're going to start investing in alternative investments, meaning syndication or passive investment strategies, you need to give yourself a little bit of runway. Now, if you are looking for investing in a deal that's going to give you immediate cash flow from day one, I am not that person, and you should not invest with us. Go invest. You're probably going to get a lower return, but go invest in an apartment complex that's already kicking out some cash flow, and you're going to fix them up one unit at a time. If you're looking for immediate cash flow, or you're trying to get your money back in 2 or 3 years, I'm not the person, and you should not invest with us. Our vision is a long-term vision. We want to do the best we can to try to double everybody's money in 5 years or less by way of a refinance, which makes it non-taxable, and then stay in and hold it long-term. And the idea is, if you've doubled your money, you probably are going to go want to invest that into another opportunity, and then hopefully another and another. But you're keeping that initial piece of equity that continues to cash flow. That's the key. The trick is you need to give yourself probably 4 to 5 years before it starts paying out in a meaningful way. So you have the option of front loading that. You have to decide what your goal is for your life, what your timeline is. And I think you should work backwards from that to decide if storage is a part of it, if Nomad is a part of it. And if it is, and it fits in with your goals, that's great. And if not, then don't do it. Find something else that fits your goal. So from the investor standpoint, storage is fantastic. Storage conversions are the way that we do it. And for us, we think it's fantastic as well. But you'd be surprised at the investors that I talk to that are like, nope, I want to do a 5-year deal and be done with it and be out. So it just depends on what everybody's individual goals are. Well,
There you go.
Lost you for just a second.
Yep. Unfortunately, I caught it and hit the pause, so we'll be okay. And Tia will edit this out.
Yeah,
So
no problem.
yeah. But I appreciate you sharing that because that gives us the insight that we need for people listening, watching this on YouTube that realize this really is a good deal. It's a real thing. So how can people get a hold of you? I know the website is nomadcapital.us.
Yep.
For everybody listening, just remember it's .us, not .com. Really important. But if they go there, is there a way for them, like a form to fill out, just contact
Sure.
information?
Yep, you can schedule a call there, nomadcapital.us. You can connect with us there. You can click the invest button, and that'll allow you to connect, send us a call, give us your information. I'm happy to connect with people. You can email me directly if you like to, clint@nomadcapital.us. You can find me
Okay.
on Facebook. I'm also on LinkedIn, Clint Harris with Nomad Capital. And I co-host the Truly Passive Income podcast as well. And that's more of an educational platform. It's not a sales pitch for Nomad, but we're out there educating about alternative investment strategies. We were blessed enough to have you on that podcast, so appreciate you doing that. But yeah, those are the places that's easiest to connect with me. I'm an extrovert by nature. I'm doing this because I love it. And I'm to the point now that it's just fun to connect with people because no matter who it is, I always learn something. So always happy to connect and chat and help people any way that I can.
I agree. And I really do appreciate you sharing all this. So everybody remember the podcast, Truly Passive Income. I was a guest on it myself, so I can vouch for it. And by the way, speaking of podcasts, if you're listening, we really want to thank you for your reviews when you leave reviews. It means the world to us because we actually don't get paid for this. I mean, there's indirect relationship building and network building. So yeah, you can say indirectly we generate revenue, but really the core focus is serving the community. It's education based, and the only way we stay alive, according to Apple and the others, is if you leave a review. So really do appreciate you doing that. This is on 30 different channels. And thank you for listening, by the way. We will look forward to seeing you on the next podcast. In the meantime, take care of yourselves. God bless you and your families. Thank you again, Clint. And we will see you all on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.